Welcome to the Savvy Commercial Real Estate Podcast, your resource for relevant, helpful, and immediately usable information regarding all things commercial real estate. Whether you are buying, selling, financing, exchanging, managing, or developing commercial real estate, rest assured you are in the right place. Savvy Commercial. Listen, apply, repeat.
Good morning and welcome to the Savvy Commercial Real Estate Podcast. I'm your host, Neil Sherman, and my guest today is Paul Fiorilla with the RD Matrix. Paul has been a commercial real estate researcher and writer for the past 25 years, including 6 years as the Vice President of Research with Prudential Real Estate Investors in Madison, New Jersey, and 12 years at Commercial Mortgage Alert, where he covered real estate capital markets as well as the CMBS market. As always, if you have any questions or comments for me, you can either send me an email at info@savvycommercial.com, or you can also contact me through our website at savvycommercial.com. And we'll have some contact information for Paul later in this episode. Paul, good morning, and thanks for joining us today.
Good morning, Neil. Actually, it's afternoon where I am, but anyway, that's good enough. Happy to be here and look forward to our discussion.
Oh, thank you, Paul. Paul, I thought it would be quite timely, if you don't mind, and without getting too political, if we just talked about the midterms, which were held 2 days ago. I guess for all of our listeners out there, this would be a good time to ask, what effect or what impact, if any, do you think the results of the midterms are going to have on the commercial real estate industry?
Well, we're now 2 days after the election, and the outcome of the control of the Senate and the House are still up in the air. If Democrats were to win, I think the biggest impact on real estate would be if the Democrats were to retain control over both houses with at least, right now, the possibility exists that they get 51 votes in the Senate. I don't know how likely that is. It's still, up in the air. But if they were to do that and retain the House, and again, retaining the House seems less likely right now, I think they might be able to pass the sort of ambitious housing agenda that Joe Biden proposed. But it was stopped by, as part of the Inflation Reduction Act. But it was taken out by Joe Manchin. So if they had an extra vote and control of the House, they might be able to pass that. And that included about $240 billion of housing subsidies and subsidies for new development, subsidies for renters, something that the industry is really excited about because, as we all know, affordable housing construction is dismal in this country, and it's a huge problem. And that was something that was meant in a very big way to address, the construction of affordable housing. I'd say, though, right now that looks less than likely that all those things are going to happen. Now, if the Republicans capture control of either the House or the Senate, then I think probably we won't see a whole lot of legislation passed because the House is certainly not going to pass any of President Biden's priorities, and whatever they pass is just going to be dead in the Senate, or it won't be veto. You won't have a veto-proof majority. So I think based on what seems likely at the moment, we're probably in for a couple of years where sort of the main political action is less legislation, but sort of the, kind of the theater.
Sure.
And especially around things like the debt ceiling. So, the debt ceiling is coming up for, needing to be raised sometime next year. If the Democrats don't address that and they lose control over, say, the House, then Republicans could force sort of a default on the debt as a way of, trying to pass something that otherwise they couldn't pass. So we could see some, kind of theatrical things. And but I mean, we're very evenly split in this country, and it has consequences. And I would just say that probably the next couple of years will have very little pass in the way of legislation,
Interesting.
good or bad for the industry.
Yeah, I was just thinking that. Well, Paul, thank you for that, by the way. Paul, I know you've written literally dozens and dozens of great articles and white papers about commercial real estate in general. However, today I'd like to focus on a couple of markets that I know both you and Yardi Matrix follow very closely, that being primarily multifamily, which includes the very hot build to rent or BTR space, as they call it. Paul, to kick us off here, can you set the table just a bit in terms of where you feel we are currently in terms of the latest Fed rate hike that occurred recently? I mean, I think it was number 3 or 4, if I'm not mistaken, as well as with inflation and investor sentiment in general, and how these situations may impact commercial real estate heading into the end of this year and early next year.
Yeah, this is another really fast moving area. If you had asked me this question yesterday, I probably would have answered it a little bit differently than I did today, because
Yeah.
this morning, we got the October inflation numbers, and inflation and core inflation and the housing component of it all look like they're going in the right direction. A month ago, inflation seemed stubbornly high. So, to just kind of go backwards a little bit, we came out of the global financial crisis, and when things stabilized, around 2013 or so, we had a very, strong run in multifamily, very, and the economy, moderate growth, which was good for commercial real estate. And up until we hit, the pandemic, and then we lost 22 million jobs, and the government passed different stimulus programs and kept people, out of work, and kept them with, their financial, being able to pay rent and things like that. Um, and eventually the jobs came back, and then starting in 2021, we had really strong job growth and really strong rent growth, and then that created the inflation problem. Combination of housing going up, energy costs going up, and supply chains disrupting the economy and creating increased costs and shipping and goods. So we had a lot of demand and little supply, and we had 40-year inflation high. So of course the Federal Reserve, which was slow to get into the game, decided that they had to act. And they've been raising rates. Right now they're 3.75 to 4% for short-term rates. And from the real estate point of view, I think when we came into this year extremely hot. You know, Multifamily, industrial, self-storage, data centers, life sciences, a lot of um, industrial, a lot of the, segments of commercial real estate have done really well. Now, office and retail have been a little bit of a laggard because of, sort of long-term trends. But most of the sector was still doing good, and multifamily and SFR and single family rental and industrial in particular were really strong, seeing record high rent growth, low vacancies, and so on. Um, when the Fed started to raise rates, I think the assumption in the market was, yeah, we're going to see, maybe about 3%. And, that's kind of not great for us, but, the Fed has to do what it has to do, and we should get inflation down. And it's not that big of a problem. But a couple months ago, when the inflation prints continued to be really high, and the Fed became more and more hawkish on inflation. And then in October, with the latest rent increase, Jay Powell, the Fed chair, sort of indicated that he was going to remain hawkish. I think it was a psychological change in the industry, and there was a lot of disappointment, a lot of sudden concern, because I mean, like the cap rates, acquisition yields for multifamily, about 4.5% on average over the last 18 months, coming into the middle of the year. Um, and, when you look at, mortgage rates, which started the year, under 3% in some cases, you could take out a mortgage for, 2.75, to 3.5%, depending on, the circumstances. Well, now suddenly we're looking at, mortgage rates north of 6% for fixed rate, and even floating rate loans have gotten tremendously expensive because SOFR, the index is over 3%, and the loan spreads have widened. Sometimes when interest rates go up, loan spreads tighten, but now we've hit a double whammy. We've had you know the base rate has gone up, and risk spreads, because people are suddenly more pessimistic about growth going forward, they've gone up too. So now you're getting, mortgage rates over 6%. So it's really hard to, operate in a 4.5% cap rate world with mortgage rates at 6%. So that's had, in the last couple months, the realization that this was going to be, you know, deeper, rate growth and debt, the cost of capital was going to be, a worse than people anticipated earlier in the year. I think that's had a very large psychological effect on the market, and practical effect. So, you know, acquisitions have stalled, not totally, but they've, dropped very sharply, because people don't know where to price things. Appraisals are very difficult, and um, it's also a lot more difficult to get debt. Most kinds of, banks have cut back their activity, and especially in construction. So, we're entering a period of uncertainty. So what does that mean for, say, multifamily rents, right? Well, multifamily rents, which went up, 15% last year, according to Yardi Matrix data and most other, sources of data in the market. And they were up pretty strong. They were up, about 7%, year to date through mid-year, but rent growth has decelerated. I think it's going to keep decelerating, for a few kind of major reasons. One is that the slowdown, the migration to the Sun Belt is slowing down, right? So one of the big drivers of demand in these high growth, high rent markets, markets where rent growth went up, 20+% in the last year, was a lot of demand coming from coastal areas, right? New York in 2020, when the pandemic hit, a lot of people left big metro areas in New York, Chicago, San Francisco, and there was a big uptick in apartment demand in, Florida, Texas, Arizona, all across the Sun Belt. People were looking for um, cheaper housing, and they were looking for, warmer, better climates, um, because they didn't have to go to their offices every day, the new work from home paradigm. So, um, but a lot of the migration was kind of pulled forward from future years, because people who might have naturally done it in another year or two, kind of everybody did it all at once. Um, so in 2021, we saw apartment demand for apartments and absorption of apartments hit a record number. About 600,000 apartment units were absorbed in 2021. Um, but, you know, So one of the sources of, or one of the reasons that rents are decelerating is that migration is slowing um, in some of the high growth metros. Another reason rents are decelerating is slower household formation. So one of the underrated elements of apartment demand and rent growth in 2021 was just that there was demand everywhere, right? So in 2020, a lot of people left, urban metros, but in 2021, New York, San Francisco, Chicago, except for downtown San Francisco, pretty much all the other major metro areas had fantastic years. All the gateway markets, all the core markets, that normally the high, what we would call the top six markets: New York, Boston, Washington, San Francisco, LA, and Chicago. They all recovered extremely well in 2021. Even though people weren't going to the office, people were still going there because of the cultural factor. Young people, turns out, still they like the cultural opportunities that they can get, going to Broadway plays, concerts, whatever, just having a lot of other peers that, to socialize with in big cities. So there was a big, recovery in demand. Um, and a lot of that was driven, a lot of the, I mentioned that, demand hit record numbers for apartments last year. A lot of that was driven by the economy. So we lost 22 million jobs in the year 2020 and 2021. And, through the middle of this year, all those jobs, by the middle of 2022, all those jobs are back. We've had extremely high wage growth, which is one of the reasons we have inflation. But on the other hand, the good part of that is that people have money to spend. Plus, people have a lot of stimulus payments that they um, collected in 2020 and never spent because there was nothing to spend it on at the time. So household balance sheets are strong. So there was all these things, um, conspire to create this demand. Well, now as the economy starts to slow down, as the Fed's making it clear that it's trying to raise the unemployment rate, so what you're having now is that household formation is is slowing down. So, people in 2021 were able to, say, leave their parents' houses. Young people, go form their own household, or they were uncoupling from roommate situations and forming their own household. Now that process is either slowed down or in some cases might reverse as, you know, increasingly companies are starting to lay off. We've seen a bunch of announcements about, say, tech firms, Salesforce, Facebook, Meta, um, Twitter. Some of these companies are announcing layoffs, so that will, reduce the strong job formation that we saw over the last couple of years. So, we have a slowdown in migration, slower household formation, and the third thing is affordability. The number of households, rents went up, 30% over a couple of years in a lot of metros. So um, the number of households that are paying more than 30% of their income as rent has gone up tremendously. And a lot of the metros that were, people moved to because they were cheaper. You could say, "Oh, it's really expensive in California. I'm going to move to Phoenix or Las Vegas or something," when it's 50% cheaper. Well, if it's only 20% cheaper, then, it's not quite the same bargain. So the affordability factor is another reason, we rents are decelerating. And, my view is that rents are going to, be flat. We're just about to hit the typical seasonal slowdown period in the winter. So I would expect that rents are going to flatten for, till the spring, and then, maybe we'll start seeing some moderate growth after that.
Paul, that's great information, by the way. And frankly, you easily addressed some of my top concerns and some of our listeners' top concerns. Um, I talk to a lot of people every single day, and over the last, I don't know, let's call it 30 days. It's probably more like 2, 3 weeks, but the number of people who have been telling me that they think all of this, they call it the stuff, or anything having to do with rate hikes, they think all of this is short-lived, temporary. There are all kinds of different adjectives that they use, but there's this sector of the population, and I mean the investor population that invests in commercial real estate, that thinks these rate increases are short-lived, and they go so far as to say, in the next 12 months, they think that rates are going to come back down, and therefore cap rates, and also that what a couple in particular said, well, thankfully, I don't have to refinance my loan for another year or two. I think rates are going to come back down, so I'm waiting because I think I'm going to get another shot at, one gentleman in particular said I'm going to get another shot at somewhere around 4 or 5%. I didn't say anything. And other people are, throwing around similar predictions, if you will, forecasts for both interest rates and cap rates. I don't know how you feel about it. I guess this is your opportunity to pull out your crystal ball. I understand that what goes up does have to come down, but do you think in the near term, like these people are talking about 6 to 12 months, we could see these interest rate increases turn around and come back down, and also see cap rates come? A couple of people have said they think we're going to see 4 or 5 caps again here locally. What are your thoughts on that? Do you think it's short term? Do you think it's more long term? Do you think that these low cap rates are in the rearview mirror for the foreseeable future? Or what are your thoughts exactly on that scenario?
Well, anything is possible, right? I mean, if, I was one of those people who expected, rates to go up, sort of in the 3.5% range. And, rates have been on a long, slow slide down for 20 years. And, they had a big jump. So how long they stay elevated? I mean, first of all, the Fed has made it clear that it's not done raising rates. So, we're probably going to see rates continue to, almost 5%, if not 5%, depending on, whether inflation keeps coming down in coming months. And that's a possibility, but it's also a possibility it doesn't, because of the way that, it's calculated. Like, for example, the inflation numbers, the rent, the housing component has a rent index built in, but it's a very lagging index. So it took a long time for the rent increases that we saw on the ground to work its way into the CPI number, and it's going to take another, few months before, 6 months or so before the decline in rent growth, or the flattening in rent growth, to work its way into the housing component of the CPI. So, um, you know, that's just a way of saying I think rates are going to keep going up, at least another 7,500 basis points, just based on, what the Fed it's publicly saying. And if you factor that in, then I would say that cap rates look like they have to go up, right? They have to go up from where they are now, uh, because there has to be some, there's not a one-to-one, you know, correlation between interest rates and cap rates. When you look at them over time, and when I was at Prudential, we did a study on this, 10 years ago, more than 10 years ago. And in periods when interest rates have gone up, um, cap rates don't always go up, um, because sometimes when interest rates go up, the reason that it goes up is because, the economy is running hot, and rents then are going up strong, and investors are willing to take a very low risk premium over, the risk-free rate, 10-year Treasury yield, because they see net income going up. So you can squeeze cap rates relative to interest rates when you're optimistic about rent growth. However, right now we're seeing interest rates go up not because the economy is running hot, but sort of the opposite, that the Fed is trying to stop the economy from running hot. So you've got a situation where rates are going up and property income is probably going to slow down, if not turn negative in some sectors. So to me, that's a bad combination for cap rates, which means I would expect cap rates to go up a percentage point or so, which if you look at it, is a 20-25% drop in property values, depending on the sector. Now, I mean, that sounds bad, but property values have gone up so much over the last few years that a 25% drop is just sort of coming down off, like, the really frothy highs. Um, and as far as how long this is going to be, I mean, it really depends on the economy. If we achieve a soft landing, you know, maybe things normalize, and I'd say that that's still a chance. I'd say somewhere of a 50-50 chance between a soft landing and a hard landing at this point. A hard landing might actually mean interest rates come down even further, but then that's also really bad for demand. So I don't know that that's really in the end, that's not a real positive for cap rates either. So I mean, I would expect, in terms of timing, I would expect cap rates to go up and to stay up, for at least 12, 18 months until there's some clarity, and some the industry has confidence that the economy and everything in the industry, demand for properties is going to stay strong for an extended period.
Well, Paul, I want to stick just for a minute with the concept of negative leverage, where, as just an example, an investor buys a property at a 6 cap. I'm just making this up, and finances it at 7.25, which, if we're not there already, we're certainly heading there quickly. 125 basis point spread, if you will, between the cap rate and the interest rate. Is this good for the market or bad for the market? When I say for the market, I'm really talking about investors. If they buy properties with this negative leverage, are they counting on appreciation to offset that negative leverage? And I guess, again, some of these things are going to require your crystal ball. But if they don't see the appreciation that they're banking on, no pun intended, what happens to these people that are buying and investing at a spread of 100, 125, 150 basis points if they don't get some significant appreciation? I mean, don't they run the risk of maybe being whipsawed a little bit? What are your thoughts on that? I
Yeah, I
realize
mean,
that's probably
if
a
you
crystal ball question.
if you if the yield you buy the property for is less than your cost of capital, you're going to lose money, right? Now, again, there have been periods where you know it, investors have done this because they're expecting that their income is going to increase. And back in 2006 and 2007, why did we have a crisis? Well, one reason was that people were buying properties for very little spread between the cost of capital and their return, but they were baking in 5-7% rent growth and low exit cap rates. So their projections um, were such that they figured that they could make money. Now, those were very optimistic assumptions, and not only did the optimism not happen, but we went into a global recession, so that created a gigantic foreclosure crisis. So in today's environment, like I was saying before, I think anybody that's assuming that rent growth is going to be strong going forward is that's just not a smart way to do business, because we're all signs point to a deceleration in rents in the sectors that were really hot, um, like multifamily and industrial and self-storage. Self-storage rents were really high last year, and now they're starting to come down as well. And then, the sectors like office and retail that have sort of long-term existential problems related to work from home and e-commerce and all that. Those sectors are very risky, and no, I don't think anybody's underwriting big rent increases in those sectors. So uh, I think anybody that's tempted to, you know, you know, purchase a property with negative leverage, I don't think that's a very smart thing to do right now. But I mean, I guess there could be properties where it works out, but it's just not a wise strategy.
Paul, I'm just going to take a quick minute to just remind everyone that you've been listening to the Savvy Commercial Real Estate Podcast. I'm your host, Neil Sherman, coming to you from Phoenix, Arizona. My guest today is Paul Fiorilla, coming to you from Yardi Matrix in, is it New Jersey, Paul?
Yeah, I'm based in New Jersey. Yardi is not. I mean,
Yep.
I'm remote, and Yardi is based in Goleta, California.
Okay. And Paul, do you mind if I share your email address in case anyone wants to drop you an email?
No, go ahead.
Okay. So if you want to send an email to Paul about anything we're talking about today, you can do that at paul.fiorilla, Fiorilla. That's F as in Frank, Iorilla. Paul.fiorilla at yardi, yardi.com. And if you want to drop me an email, you can do so at info@savvycommercial.com, or you can go to our website at savvycommercial.com. Paul, I want to stick with financing just for another couple of minutes, if you don't mind, and talk about people. And when I say people, real estate investors who have leverage on their properties. They have financing on their properties. They got those loans back when interest rates were anywhere from 3.5, 4, etc. And let's say they didn't lock those rates for 10 years and they only locked them for 5. I mean, if they're on an adjustable rate, that's a whole different story. We won't go there today. I feel bad for those people. But if they had a 5-year rate lock and that rate comes up in the next 6 to 12 months, or that loan comes due, I should say, in the next 6 to 12 months, and they're facing refinancing at a higher rate, let's call it 6.5, 7, 7.5, who knows where it's going to be. Not only is that going to screw up their projections and their numbers, but there's also, I guess, a possibility that they'll have to pay down that loan, because it's very likely that the lender won't want to have the same exposure going forward. What are your thoughts on that, both on the need to refinance at maybe a higher interest rate, and maybe the requirement to pay down the principal, because either that same lender or your new lender, if you're going to a different lender, they don't want to loan the exact same dollars going forward? Do you see either of those as a likely scenario? And if so, is that going to cause problems? Are we going to have some distress in the market? Or do you don't think that's going to be a really big deal?
Well, there were a lot of questions there. I think it was yes, 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 and no. Um, but no, I mean, actually, I wrote something about this not too long ago, and one of the ironies of a few years, 2021, let's say, and was that when rates were so low, you think that would have been a great time to lock in long-term debt, but a lot of borrowers didn't, just because rates, they got lulled by the fact that rates have been so low for so long, and they figured that was going to continue, and that they could refinance, with higher proceeds because, they were very optimistic about rent growth. Um, but there were a lot of loans originated. So, for example, the collateralized loan obligation market, which are loans originated by private equity firms, um, that are put into securitized transactions called, CLOs, and then, the bonds are sold to investors. It's like CMBS. Um, so there was record, volume last year, like 45 billion of those. Most of that was even multifamily. I think 28 billion of that was multifamily, according to Commercial Mortgage Alert. So you have a situation where there's a lot of floating rate debt originated that's, coming due in the next couple of years. If rates stay where they are, um, then we're having that situation you just described, 3% loan being, refinanced into a 6% mortgage environment. So, I mean, I just did a little math recently. And so if you take a $10 million property that was leveraged at 70%, so as a $7 million mortgage at a 3% interest rate, 30-year amortizing loan, you look at the monthly payments, and then how much would, if you keep the monthly payments the same, how much would that borrow be able to borrow at 6% with, the same repayment schedule? And the answer was, 4.9 million. So the gap between what you could borrow on the same property at a 3% rate, um, is $2.1 million more than you could borrow for the same property with the same payments at a 6% rate. So, at refinancing, that theoretically, you know, creates a situation where the property owner has to come up with another $2.1 million
Wow.
to pay off the loan, um,
Which not everyone can do, obviously.
which not everyone can do. So you have, you're going to see this situation play out in a lot of properties. And there are, a bunch of options. One is the borrower could just, put more equity in, which reduces their returns. They could do that. Another thing is they could, take out gap capital, which would either be a mezzanine loan or a preferred equity. Now, right now, there's a lot of money being raised for that type of thing because this is the kind of opportunity that we've seen come up in the past when this has happened. And there's a lot of savvy, private equity investors out there that, um, have been doing this for a long time. And this type of capital has, in the way the market has been in the last decade, there hasn't been a lot of use for this type of gap capital. But now we're, there'll probably be, some sort of demand for it going forward. So there's a lot of money being raised for that. And this, right now, from what I'm hearing, the that kind of preferred equity, mezzanine capital, and the 50 to 75%, part of the capital stack is getting 12 to 15% unlevered returns. And now, mezzanine loans, that's, kind of twice what mezzanine loans were getting, before rates started going up in the spring. So that's a solid investment for, the investor. Another possibility is that, banks will exercise some level of extend and pretend and hope that, um, the loans will just sort of cure themselves over time, or the banks might renegotiate the terms or something to avoid having to, have some kind of a foreclosure situation. So, we're probably going to see a lot of this type of situation coming up. Um, you know, it could lead to an epidemic of distress, but more likely, in my opinion, it'll lead to, more of, kind of these gap capital deals or extended deals or things like that. Because I think after the global financial crisis, there were a lot of predictions and about default, kind of like, oh, another RTC type situation. But it didn't really materialize. There was, an increase in defaults and, kind of loan workouts, but a lot of the cases, the lenders and the banks worked with the borrowers and other capital sources and kind of work things out, so it didn't reach the foreclosure stage. It's probably the kind of thing we're going to wind up seeing going forward.
Paul, this is great stuff. I wish we had a lot more time because you're just a wealth of information, wealth of knowledge. Um, we are coming down to the end of our time together, but I'm just looking at some of the notes to myself where I just wrote a couple of key terms that I wanted to run by you. So maybe we could do this as kind of a speed dating kind of thing. I only have 3 or 4 of these. I'm just going to fire them off to you. Maybe you can just give me some like 1 minute answers on these so we can get to all 4 of them. The first one has to do with supply chain issues. We didn't talk too much about supply chain issues. I know that for the last couple of years we've been hearing about how, and I'm talking about supply chain issues, particularly as they apply to builders, developers, contractors, and so on. Prices of lumber, steel, concrete, glass, etc. I know everything spiked. I know it was taking months and months to get some of this stuff. But now I'm reading in a number of different places that some of these things are becoming more readily available. Some of the prices have been coming down. Lumber seems to stick in my mind. The more readily available building supplies and maybe even a price reduction in building supplies. Do you think that's going to help builders and developers greatly, or do you think a lot of that might be offset, maybe even completely offset, by the fact that they're paying higher interest rates on their construction financing, for example? What are your thoughts on that?
Yeah, well, very quickly, I mean, construction costs have, risen and it's become a problem. But yeah, I mean, it's a very good thing that the supply chains are improving and that the cost of shipping has gone down. However, for construction is still going to be constrained because of the difficulty in arranging debt and the cost of debt. And I was on a call. Somebody from CBRE said, just this morning, I heard him say that the cost of financing has gone up from about 5% to 10% cost of funds,
Wow.
that you have to count on. Plus, there's lower leverage for the builder. So it's a really good thing that supply chains are improving. Um, but construction is still going to be difficult to start, because of labor costs and because of the growth in the cost of financing.
So sticking with new construction just for a moment, um, I was thinking maybe you were going to say that it could lead to lower prices either in the for rent market or the for sale market, but it sounds like we might not be seeing um, a tremendous correlation maybe between new construction and costs for rent or costs for sale. Maybe there's just not going to be enough new construction to have a market effect on either of those. Am I right on that or no?
Well, it depends on the property type and the location, because I mean, like multifamily right now, we have in our database almost 1 million properties on multifamily units under construction.
Wow.
But I think the starts are going to slow down. So we're talking, at least 400,000 units delivered still for the next couple of years. But I think starts are going to slow down just because of the difficulty in getting financing. Now, ultimately, long term, that's creates pressure on rents because if this continues and construction continues to be slow in the next couple of years, then that'll push rents up higher. But again, there's a big variation between markets. You look at Austin and Charlotte, where they're adding 5% of units per year to some of the major markets like New York, where they're adding 1% to stock per year. That's a big difference. Um,
I have two more quick questions for you, Paul. These are both, I think, right up your alley based on what you've been saying on this conversation in this episode. First one is transaction volume. 20 and 21, I don't have the exact numbers in front of me. You might, but those were off the charts. I think historically high numbers, if I'm not mistaken. Then you've got this year and next year. So how do you think 20 and 21, when the dust settles, I guess, at the end of next year, how do you think 20 and 21 transaction volumes are going to compare to this year and next year's transaction volumes? Higher, lower, the same? No comment?
well, this year it's definitely going to, 2021 was the peak transaction year in the history of the market ever. In multifamily, we tracked $226 billion of multifamily sales. Yardi Matrix did. MCSI for all transactions was over 800 billion. Did I say million? 226 billion multifamily, over 800 billion in all transactions per MCSI, which again were by far records. And we started this year for the first 4 or 5 months or so, kind of on that same level. And then of course rates started to go up, and there was a slowdown, and now rates have gone up even more, like I was talking about before. So I think the slowdown is going to be a lot steeper the rest of the year. So by the end of this year, because there was still the first half of the year was transaction activity was so strong, this year is going to be a good year for transactions, relative to any other year but last year. But next year, I think there's definitely going to be a slowdown, just because, appraising properties is difficult. Banks are less active. All types of lenders, pretty much are less active, except maybe life companies. But they're a small part of the overall lending market. CMBS is really down a lot volume wise, and because of loan spreads, they're quoting really high rates, so they're not very competitive. The agencies are strong in multifamily, but again, they have a limited allocation, so they can't finance everything. Their allocations are about $80 billion a year, so and they might even get to that. So, I mean, transaction activity next year, I would expect to, kind of drop even below this year's levels.
Paul, we are coming to the end of our time together. I have one more question I'd like to throw out at you. Keep that crystal ball on your desk there. And looking forward, right, 2023 and maybe beyond, we don't want to go out too far, or maybe the next 12 to 24 months, where do you see the best opportunities, specifically in the commercial real estate market, since this is a commercial real estate podcast? And that could be a specific asset class. It could be a market, a property market. It could be a geographic market. But, for all of our listeners who are, thinking about where to put money over the next, 1, 2, maybe even 3 years, any recommendations, anything they should consider maybe staying away from, anything, anywhere you think that they should be maybe putting more capital, and where they may fare better over the next 12 to 24 months or so? You have any thoughts on that?
Well, I think that there's going to be opportunity on the debt side. So you take even like senior mortgages, right? If you're making 6% at a senior mortgage, that's more than your cap rate on equity would have been a couple years ago. Plus, I was talking about the gap capital. I mean, that's a tremendous opportunity, very, very high yields. Um, you know, multifamily, I would still think is a very strong investment, even though you have to be, I mean, I would avoid negative leverage and I would avoid, unrealistic assumptions. But if you could find properties that are in growing markets, there's still parts of the country that are growing rapidly, and stay away from places that are overdeveloped. And even some of the core markets that are, a lot of investors have moved out of core markets. Um, but, you know, in a downturn, we start to see that, the primary markets, there's a reason that they've been so liquid over the years because they continue to perform well. But, I mean, with all, um, I mean, office has its risks. So, there's some parts, medical office places where there's, pharmaceutical, biotechnology tenants, are, those are growing areas of the economy, relatively safe. So, there are investments. You just, I think, have to do your homework to make sure that both the property type and the market that you're in the submarket, have the types of, characteristics that you're looking for, and, continue to be, um, sort of, not too aggressive on your assumptions, and conservative on your assumptions. And if you can find things like that, and then again, like on the kind of the mezzanine part of the market, there's should be a lot of good investments in that.
Paul, I did say that was our last question, but just maybe as a quick part B to that, I was looking at Yardi Matrix's website earlier, and I know you guys track boat storage, RV storage, self storage. We didn't talk much about that, although you did mention that self storage rents were probably going to be coming down a bit, which to me means self storage values may also be coming down a bit. But just those three areas very quickly. Boat and RV storage, maybe it's two areas. Boat and RV storage and self storage. Again, your predictions for those two spaces over the next year or two?
Yeah, self-storage benefited a lot from, kind of the strong migration and all the other factors, the, displacement, death is one of the drivers of storage. And there was a lot of that in 2020. So, self-storage rents went up a lot. The pandemic, there was a slowdown in new deliveries for a little bit. And so that market did really well. The growth has slowed down, sort of like is happening in multifamily. But I think, going forward, storage, especially in markets that are rapidly growing, we've seen, there's a real correlation between growth in storage rates in metros, in the Sun Belt, where, there's a lot of population growth. Um, and RV boat storage is a segment of self-storage that is a really strong opportunity because there's just a demand, right? The number of RVs and boats hit record sales in 2021, and this year it's kind of close to that. It's gone down a little bit, but in the last few years, there's been a huge increase in the number of RVs and motorboats that people own, and there hasn't been a similar increase in the amount of storage space for them. Most people live somewhere where they can't keep them and their properties because of either, the local zoning codes, or they're in, their home, they're just because of the rules of where they live. So they need a place to store them, and they're just, there's not a lot of places to store them to start with, and there's not a lot of construction. It's a very fragmented, not a lot of institutional involvement in that market. So the demand is really high for RV and boats, particularly for climate controlled facilities, which there are very few of, because people want to store them in a place where they won't deteriorate. They spend hundreds of thousands of dollars in some cases on these vehicles. They don't want to leave them out in the weather. So that's a very strong opportunity. There's a lot of demand both for new units and for sort of institutional, capital management in that sector.
Interesting. Well, Paul, this has been an absolute pleasure. I hope you will join us again, or at least consider joining us again next year, where I'm sure there'll be, especially after the midterms are squarely in our rearview mirror, and we start to maybe see more of the effect of higher interest rates, possibly higher cap rates. I'm sure we'll have all kinds of things to talk about. Again, if you've been listening today, this is the Savvy Commercial Real Estate Podcast. I'm your host, Neil Sherman, and our guest has been Paul Fiorilla, who has done an absolute phenomenal job dealing with some questions concerning the commercial real estate sector, what's going on in the world, interest rates, you name it. Paul, again, I'm just going to drop your email address in case anyone wants to send you an email and communicate with you. Paul, P-A-U-L, first name, Fiorilla, Fiorilla @yardi.com. So it's paul.fiorilla@yardi.com. Yardi is YARDI. If you want to send me an email, you can do it at info@savvycommercial.com. Or, as always, you can check out our website at www.savvycommercial.com. Paul, thank you very much. We're at the end of our time together. I really appreciate everything, and we hope to have you back again.
Hey, thank you, Neil. It's been my pleasure, and I will talk to you soon.
Thank you, Paul. Have a great day and a great weekend, and happy holidays.